Hello everyone, and welcome back to the channel. I'm John, and I'm really glad you're here. What if the biggest move in the silver market had nothing to do with supply shortages or real demand, and everything to do with how the system itself works? In this video, we're breaking down what really happened in the silver market during its extreme volatility. We'll look at how futures trading in paper silver influence prices, why margin hikes can trigger sudden crashes, and how large institutions and market structure shape market movements behind the scenes. We'll also explore the growing disconnect between physical silver and paper markets, the role of interest rates in the US dollar, and how investor psychology can turn a powerful rally into a rapid sell-off. Most importantly, we'll connect all of this to the bigger picture, what it means for investors, industries, and the future of precious metals. And quick update before we dive in, we're launching on Twitter very soon. I'll be sharing market insights, updates, and real-time thoughts there, so make sure to check the link in the bio once it's live, and follow us to stay connected beyond YouTube. So if you want to understand silver beyond the headlines and learn how modern commodity markets really work, stay with me. Let's get started. The silver market crash and JP Morgan's short covering. In early 2026, the global silver market experienced one of the most extreme episodes of volatility in decades. After a powerful rally that drove silver to multi-year highs, the price collapsed by more than 30% in a single trading session, marking the largest daily percentage drop in nearly half a century. On Friday, January 30th, 2026, spot silver plunged to roughly $78 per ounce after earlier touching all-time levels above $115, wiping out enormous amounts of market value. Gold also suffered sharp losses in the same sell-off. We lost $3.5 trillion value in the market, but nobody tell you these. This discussion focuses on the mechanics behind that dramatic drop and the behavior of large financial players in the futures market. In the months leading up to the collapse, silver had attracted significant attention from both industrial and speculative investors. Prices surged more than 100% in 2025, driven in part by strong industrial demand for the metal in sectors such as solar photovoltaics and electric vehicles. Analysts noted that silver's dual role as both an industrial commodity and a monetary hedge made it particularly responsive to shifts in inflation expectations and demand forecasts. A core feature of this episode was the structure of the silver futures market, especially on the COMEX exchange run by the CME Group. Futures contracts allow traders to take large positions with relatively small upfront capital, using leverage, by posting margin instead of the full contract value. While leverage amplifies gains when prices rise, it also increases vulnerability to sudden reversals. Throughout late 2025 and into January 2026, the CME Group implemented a series of margin requirement increases on silver futures in response to heightened volatility and rapidly rising prices. These adjustments raised the collateral traders needed to hold positions, particularly leveraged long bets. In several instances, margin requirements were raised during thin holiday trading periods, when liquidity is lower and forced selling can have outsized effects on prices. The timing and scale of these increases contributed to a cascade of forced liquidations, as traders who could not meet higher margins were compelled to close positions, pushing prices lower. In the midst of these market swings, attention turned to large institutional participants, especially major banks with significant positions in silver futures. The narrative that emerged among some traders and analysts was that JP Morgan, one of the largest holders of silver futures positions globally, closed substantial short positions near the market bottom during the crash. Short positions, where traders sell contracts in anticipation of a price decline, can incur mounting losses when prices rise. Covering these shorts by buying contracts back can itself influence market pricing, particularly when done at scale. While JP Morgan and other major clearing banks do not routinely disclose detailed position data in real time, market observers cited reports and on-chain data suggesting large futures unwinding at key price levels during the sell-off. The interaction between margin hikes, leveraged positions, and shifting market sentiment was further amplified by macroeconomic news. On the same day as the price collapse, markets reacted to the nomination of a new Federal Reserve chair perceived as more committed to fighting inflation and less inclined toward easy monetary policy. A stronger dollar can put downward pressure on dollar-priced commodities like silver by making them more expensive for international buyers. Some analysts argued that this shift in expectations added to selling pressure in an already fragile technical environment. It is important to underscore that while the term crash often carries dramatic connotations, the mechanics here were rooted in the structural features of futures trading, leverage, margin requirements, and liquidity dynamics, rather than any single physical shortage of silver. Indeed, research on the market structure shows that physical silver supply remained constrained by industrial demand and inventory depletion, but the extreme price moves largely reflected shifts in paper markets and speculative positioning. In summary, the January 2026 silver price collapse was driven by a combination of volatile price action, Recurring margin hikes by COMEX, forced liquidation of leveraged positions, and large institutions adjusting futures exposures under stress. The episode highlighted how futures markets can amplify price swings, especially when multiple risk management mechanisms converge under stressed conditions. The unwinding of large short positions near the market's lows, attributed by some to JP Morgan, illustrated the profound impact that major players can have on directional moves, especially when leverage and technical triggers align. On the next, COMEX, paper silver, and how market structure shapes prices. To understand what happened next in the silver market, it's important to look beyond price charts and focus on the structure of the market itself. As per information collected from market research, regulatory filings, and publicly available data, silver pricing is largely driven not by physical metal changing hands, but by futures contracts traded on major exchanges, most notably the COMEX in the United States. COMEX. Silver futures represent agreements to buy or sell silver at a future date, but only a very small percentage of these contracts ever result in physical delivery. Research consistently shows that the overwhelming majority are closed or rolled over before expiration. This creates a situation where the volume of paper silver traded can be many times larger than the amount of physical silver available in registered inventories. As per market structure analysis, this imbalance means that price discovery is often driven by financial positioning rather than real-world supply and demand. During periods of rising prices, speculative interest increases sharply. Data from futures positioning reports shows that leveraged traders, such as hedge funds and short-term speculators, tend to build large positions when momentum is strong. These positions are funded using margin, not full contract value, which amplifies both gains and losses. As per exchange rules, margin requirements are adjusted when volatility rises, with the stated goal of reducing systemic risk. Research into past commodity cycles indicates that sudden margin increases during high volatility phases can have unintended consequences. When margins are raised, traders must add capital to maintain positions. Those unable or unwilling to do so are forced to liquidate. This selling pressure can rapidly push prices lower, triggering further liquidations in a chain reaction. As per historical market behavior, this mechanism has played a role in multiple sharp commodity corrections over the past several decades. Another key factor, discussed in market research, is the distinction between paper silver and physical silver. While futures prices collapsed rapidly, physical silver markets behaved differently. Reports from dealers, refiners, and industrial users indicated that physical demand remained resilient, particularly from industrial sectors such as energy transition technologies and electronics manufacturing. Premiums on physical silver products did not always fall in line with futures prices, suggesting a disconnect between financial markets and physical availability. This disconnect has been documented repeatedly in academic and industry research. Analysts note that futures markets excel at providing liquidity and hedging tools, but they can also exaggerate short-term price movements when dominated by leveraged financial players. As per regulatory data, a relatively small number of large participants often control a significant share of open interest in silver futures, giving institutional behavior outsized influence on short-term price direction. From a broader perspective, silver's dual identity adds complexity. It is both an industrial input and a monetary metal. Research from economic and commodity studies shows that this makes silver more volatile than gold, especially during periods of changing interest rate expectations, inflation outlooks, and currency strength. When macroeconomic signals shift suddenly, futures markets tend to react immediately, sometimes before physical markets can respond. Another element highlighted in market analysis is liquidity concentration. During off-peak trading hours or periods of thin volume, relatively modest sell orders can move prices aggressively. When this coincides with margin changes or algorithmic trading triggers, price declines can accelerate far beyond what fundamentals alone would justify. As per available trading data, this pattern was visible during the sharp silver sell-off. What this topic makes clear is that silver price movements are not solely the result of supply shortages or demand surges. They are also shaped by exchange rules, leverage dynamics, institutional positioning, and the dominance of paper trading over physical settlement. As per collected research and public information, understanding these mechanics is essential for interpreting extreme volatility events. In short, this discussion shows that the silver market is not broken, but it is highly sensitive to structure. When leverage, margins, and concentrated participation collide, prices can move violently, even when underlying physical conditions change slowly. This structural reality sets the stage for deeper questions about market transparency, fairness, and the long-term implications for investors and industries that rely on silver. Now, on the next, physical silver versus paper markets, the growing disconnect. As the silver market stabilized after the extreme volatility, attention began shifting toward a critical question: what was happening in the physical silver market while paper prices were collapsing? As per information collected from market research, industry reports, and publicly available data, the answer revealed a growing disconnect between futures trading and real-world silver availability. While paper silver prices fell sharply on exchanges, physical silver did not experience the same level of collapse. Reports from bullion dealers, refiners, and industrial buyers indicated that physical demand remained steady and in some cases even increased during the sell-off. This pattern has been observed in previous market stress events, where sharp declines in futures prices triggered renewed interest in physical metal rather than panic selling. Research into silver supply chains shows that physical silver production is relatively inelastic in the short term. Mining output cannot be quickly increased in response to price spikes, and a large portion of silver supply comes as a byproduct of mining for other metals such as copper, lead, and zinc. As per industry data, this structural limitation means that physical supply responds slowly to market signals, unlike futures contracts, which can be created or closed instantly. At the same time, industrial demand for silver has continued to grow. Research highlights silver's essential role in solar panels, electronics, medical equipment, and electric vehicles. These industries rely on consistent supply rather than short-term price movements. As a result, many industrial buyers maintain long-term procurement strategies and are less sensitive to futures market volatility. This helps explain why physical demand did not collapse alongside paper prices. Another indicator of the paper-physical disconnect was behavior in wholesale inventories. As per reported exchange data and vault disclosures, registered silver inventories did not surge in response to falling prices. In some cases, inventories declined as metal moved out of exchange-approved vaults into private storage or direct industrial use. Research suggests that when confidence in futures pricing weakens, participants prefer holding physical metal rather than rolling contracts forward. Premiums on physical silver products offered another clue. Despite the sharp drop in spot prices, premiums on coins, bars, and industrial-grade silver remained elevated compared to historical averages. This pattern has been documented in market research during periods of stress and suggests that physical availability was tighter than paper prices implied. From a structural standpoint, research consistently shows that the futures market is primarily a price-setting mechanism, not a delivery system. Only a small fraction of contracts result in physical settlement, meaning that large price moves can occur without significant changes in physical ownership. As per regulatory filings, this design is intentional, allowing for liquidity and hedging. But it also creates the potential for price signals to diverge from physical reality during extreme events. This divergence raises important questions for investors and policymakers. Research into commodity market stability indicates that prolonged disconnects between paper and physical markets can undermine confidence in price discovery. When futures prices fail to reflect actual supply constraints or demand strength, market participants may seek alternative benchmarks or reduce reliance on traditional exchanges. Silver's unique position amplifies this issue. Unlike purely industrial metals or purely monetary assets, silver sits at the intersection of both worlds. Research shows that this dual role increases sensitivity to financial speculation while maintaining underlying physical importance. When financial positioning unwinds rapidly, the physical market often acts as a stabilizing force rather than following prices lower. In conclusion, Detailed highlights that the silver market volatility was largely a paper market phenomenon. As per collected research and industry data, physical silver supply and demand remained relatively stable, even as futures prices swung violently. This growing disconnect underscores a central theme of the silver market. Short-term price action is often driven by financial mechanics, while long-term value is anchored in physical reality, big banks, market power, and regulatory oversight. As the silver market turbulence unfolded, attention increasingly turned toward the role of large financial institutions and the regulatory framework governing precious metals trading. As per information collected from market research, public filings, and regulatory disclosures, a relatively small number of major banks play a central role in silver futures markets, both as liquidity providers and as dominant position holders. Large banks participate in the silver market in multiple capacities. They act as market makers, clearing members, and counterparties for hedgers and speculators. Research into futures market structure shows that these institutions often hold significant long and short positions simultaneously, depending on client flows and risk management strategies. This allows them to profit from spreads and volatility rather than directional price bets alone. However, the concentration of activity among a few large players means their actions can have an outsized impact on price movements during periods of stress. As per publicly available regulatory data, position concentration in silver futures has historically been higher than in many other commodities. Studies analyzing commitment of traders reports show that a small group of commercial participants frequently controls a substantial share of open interest. While this concentration is not inherently illegal, research suggests it can amplify volatility when positions are adjusted rapidly in response to margin changes or shifting macroeconomic conditions. Regulatory oversight of these markets in the United States falls under federal agencies tasked with ensuring fair and orderly trading. As per regulatory frameworks, exchanges are responsible for setting margin requirements and monitoring risk, while regulators oversee compliance, reporting, and market conduct. Research into enforcement history indicates that regulators generally focus on systemic stability rather than short-term price outcomes. During the silver price collapse, margin increases were implemented as part of risk management protocols. From a regulatory perspective, these actions are designed to protect clearing systems from default risk. However, research and expert analysis show that such measures can unintentionally favor well-capitalized institutions over smaller traders. Large banks are typically able to meet higher margin requirements without liquidating positions, while leveraged participants are often forced out of the market at unfavorable prices. This dynamic has fueled ongoing debate about fairness and market access. Research into financial market structure suggests that rules applied uniformly can still produce uneven outcomes due to differences in capital and liquidity. In highly leveraged markets like silver futures, this imbalance becomes especially visible during periods of rapid price movement. Another area of focus is transparency. While large market participants are required to report positions above certain thresholds, detailed real-time data is not publicly available. As per market research, this lack of granular visibility makes it difficult for smaller investors to assess positioning risks or anticipate large-scale unwinds. Academic studies have shown that information asymmetry can contribute to sudden price dislocations when major players adjust exposure. Despite recurring public concern, research indicates that proving intentional manipulation in complex derivatives markets is extremely difficult. Price movements must be shown to result from deliberate efforts to distort markets, rather than from risk management, hedging, or liquidity provision. As a result, most investigations focus on structural weaknesses rather than individual intent. The silver market episode highlighted a broader issue. Modern commodity markets are deeply financialized. Research into commodity financialization shows that price discovery increasingly reflects capital flows, leverage, and institutional behavior, rather than just physical fundamentals. This shift has improved liquidity, but also increased susceptibility to rapid, feedback-driven moves. In summary, this discussion examines how the concentration of power among large banks, combined with regulatory structures designed for stability, can shape market outcomes in ways that are not always intuitive. As per collected information and research, the silver market collapse was not the result of a single actor, but of a system where capital, strength, leverage, and rules intersected under stress. Understanding this dynamic is essential for interpreting not only silver's volatility, but the behavior of modern commodity markets as a whole. Interest rates, the US dollar, and investor psychology. To fully understand the silver market's violent swings, it's essential to step back and look at the broader macroeconomic environment. As per information collected from economic research, public policy analysis, and market behavior data, changes in interest rate expectations and US dollar strength played a major role in shaping investor decisions during this period. Silver, like other precious metals, is highly sensitive to interest rates. When interest rates rise, or are expected to remain high, the opportunity cost of holding non-yielding assets such as silver increases. Research consistently shows that higher real yields tend to pressure precious metal prices, particularly in futures markets where traders respond quickly to macro signals. During the period surrounding the silver sell-off, market participants were actively reassessing expectations around U.S. monetary policy. As per publicly available economic data and policy commentary, inflation remained a concern, but central bank messaging suggested a continued commitment to controlling price growth rather than easing aggressively. This shift in expectations affected speculative positioning across commodity markets. Traders who had previously bet on falling rates and currency debasement began reducing exposure as policy uncertainty increased. The US dollar also played a critical role. Research into commodity pricing shows that a stronger dollar generally puts downward pressure on dollar-denominated assets like silver. When the dollar strengthens, it makes commodities more expensive for foreign buyers, reducing global demand in financial markets, even if physical usage remains stable. During the silver correction, currency markets reflected renewed confidence in the dollar relative to other major currencies. This macro backdrop influenced investor psychology in powerful ways. Research into behavioral finance demonstrates that markets often move not just on data, but on expectations and narratives. Silver's rapid rise had attracted a large number of momentum-driven participants who were highly sensitive to shifts in sentiment. When macro signals began to change, confidence weakened quickly. As per trading behavior analysis, once prices started falling, fear replaced optimism at an accelerated pace. Stop-loss orders were triggered, leverage positions were unwound, and algorithmic trading systems amplified the move. Research shows that during high volatility events, market participants often react defensively, prioritizing capital preservation over long-term fundamentals. Another psychological factor was crowd positioning. Studies of futures markets indicate that when too many participants are positioned on the same side of a trade, markets become fragile. In silver's case, bullish sentiment had reached elevated levels following the strong rally. As per positioning data analysis, this made the market vulnerable to sharp reversals once momentum shifted. Media narratives also influence behavior. Research into financial communication shows that dramatic headlines can intensify emotional responses, especially among retail participants. As prices collapsed, the focus shifted from long-term supply and demand to short-term losses, reinforcing selling pressure. This feedback loop between price action and sentiment is a well-documented feature of speculative markets. Importantly, macroeconomic forces did not affect physical silver users in the same way. Industrial buyers tend to operate on longer planning cycles and are less reactive to short-term interest rate movements. As per industry research, this divergence further explains why financial markets experienced extreme volatility while physical demand remained relatively stable. This discussion underscores a key lesson. Silver does not trade in isolation. Its price reflects a complex interaction between monetary policy expectations, currency dynamics, leverage, and human psychology. Research shows that even strong long-term fundamentals can be temporarily overwhelmed by shifts in macro narratives and investor sentiment. In conclusion, this detailed highlights how changes in interest rate outlooks and dollar strength acted as catalysts in an already fragile market. As per collected research and observed behavior, the silver sell-off was as much a psychological and macroeconomic event as it was a structural one. Understanding these forces is essential for interpreting why silver moves the way it does, and why volatility often arrives faster than fundamentals can justify. And now the long-term implications for investors, industry, and market trust. After the extreme volatility in silver markets, the focus naturally shifts from what happened to what it means going forward. As per information collected from market research, economic studies, and long-term commodity analysis, episodes like this tend to leave lasting effects on investor behavior, industrial planning, and trust in financial markets. For investors, one of the most significant implications is a reassessment of risk. Research into commodity cycles shows that sharp corrections often lead market participants to reduce leverage and adjust expectations about volatility. Silver's price action served as a reminder that even assets perceived as safe or inflation-resistant can experience sudden and severe drawdowns when financial positioning becomes crowded. As a result, many investors begin to differentiate more clearly between short-term trading and long-term ownership. This distinction has important consequences. Futures and derivatives are primarily tools for hedging and speculation, while physical silver ownership is often driven by long-term considerations, such as wealth preservation and industrial necessity. Research suggests that after periods of financial stress, some investors shift away from leveraged instruments and toward direct exposure, viewing physical assets as less vulnerable to sudden rule changes or margin pressures. From an industrial perspective, the volatility highlights supply chain vulnerabilities. As per industry research, companies that rely on silver for manufacturing are increasingly aware that price stability matters as much as price level. Sudden swings complicate budgeting, procurement, and long-term investment planning. In response, some industrial users explore longer-term supply agreements, inventory buffers, or alternative materials where possible, although silver's unique properties often limit substitution. The episode also raises broader questions about market trust. Research into financial systems shows that confidence in price discovery is essential for efficient markets. When futures prices move in ways that appear disconnected from physical supply and demand, participants may question whether markets are serving their intended purpose. This does not mean markets are failing, but it does suggest that structural features deserve closer scrutiny. Regulatory discussions often follow such events. As per historical precedent, periods of extreme volatility typically lead to renewed debate about margin policies, position limits, and transparency. Research indicates that regulators face a difficult balance, reducing systemic risk without discouraging participation or concentrating power among the largest players. These conversations tend to unfold over years rather than weeks, but they shape the future landscape of commodity trading. Another long-term implication involves education and awareness. Research into investor behavior shows that market shocks accelerate learning. Participants become more attentive to leverage, liquidity, and the mechanics of derivatives. In silver's case, many traders gained a clear understanding of how futures markets operate and how quickly conditions can change when volatility spikes. At the same time, silver's fundamental role remains unchanged. Research consistently points to growing long-term demand driven by technological and energy-related applications. This underlying demand provides a stabilizing foundation, even if prices experience significant short-term turbulence. Over longer horizons, physical usage and supply constraints tend to reassert influence over pricing. This also highlights a broader trend in modern markets: financialization. As commodities become increasingly traded as financial assets, their prices reflect not only physical realities but also capital flows, macroeconomic narratives, and risk management rules. Research suggests that this trend increases liquidity but also raises the likelihood of sharp, self-reinforcing moves during periods of stress. In conclusion, focuses on what the silver market episode teaches us about risk, structure, and resilience. As per collected research and observed outcomes, the long-term impact is not a rejection of silver or its markets, but a deeper awareness of how complex and interconnected modern commodity pricing has become. For investors, industries, and regulators alike, these lessons will shape decisions well beyond this single event. Now, the next question is what the silver market episode really tells us about the future. As we bring everything together, it becomes clear that the silver market turmoil was not just a price event. It was a stress test for the entire system. As per information collected from market research, economic analysis, and observed trading behavior, this episode revealed how modern commodity markets function under pressure and what that means for the future. At its core, the silver market did what complex financial systems often do during moments of extreme tension. It exposed structural weaknesses. Leverage magnified gains on the way up and accelerated losses on the way down. Margin rules, designed to protect the system, intensified selling when volatility surged. Institutional positioning, concentrated among a small number of powerful players, shaped price direction far more quickly than physical supply and demand ever could. This does not mean silver lost its value or relevance. Research consistently shows that silver remains a critical industrial metal with long-term demand driven by technology, energy transition, and manufacturing. What changed was perception, particularly around how prices are formed in the short term. Futures markets proved efficient at transferring risk, but not necessarily at reflecting physical reality during extreme conditions. One of the most important lessons from this episode is the difference between price and value. Price is influenced by leverage, liquidity, sentiment, and rules. Value is anchored in utility, scarcity, and long-term demand. As per collected research, when markets become dominated by financial positioning, price can temporarily drift far from value. Over time, however, fundamentals tend to reassert themselves. This distinction matters for every type of participant. Short-term traders learned how quickly momentum can reverse when macro conditions change. Leverage participants were reminded that margin is not a formality, it is a risk multiplier. Long-term investors gained clarity on why physical ownership behaves differently from paper exposure. Industrial users saw firsthand why stable access to supply matters more than day-to-day price fluctuations. The episode also reinforced a broader trend shaping all commodities: financialization. Research shows that commodities are increasingly treated as financial assets rather than physical goods. This brings liquidity and access, but it also introduces volatility driven by capital flows instead of material constraints. Silver, because of its dual role as both an industrial and monetary asset, sits at the center of this tension. From a systemic perspective, trust becomes the key issue. Markets rely on confidence that prices are fair, transparent, and reflective of reality. When sharp disconnects appear between paper markets and physical conditions, questions naturally arise. As per historical precedent, such moments often lead to calls for reform, greater transparency, or alternative ways of assessing value, even if structural change happens slowly. Looking ahead, research suggests several outcomes are likely. Volatility may remain a defining feature of silver markets, especially as macroeconomic uncertainty persists. Market participants are likely to be more cautious with leverage. Physical demand is expected to continue growing, providing long-term support even if short-term pricing remains unstable. And awareness of market mechanics will play a bigger role in how investors approach precious metals. Most importantly, this episode reminds us that markets are human systems. They are shaped by rules, incentives, fear, confidence, and behavior under stress. Silver did not move in isolation. It reacted to policy expectations, currency shifts, institutional decisions, and collective psychology. Understanding this complexity is the difference between reacting to headlines and truly understanding what's happening beneath the surface. In conclusion, the silver market event was not an anomaly. It was a signal of how modern markets behave when leverage, structure, and sentiment collide. As per collected information and research, those who learn from this episode will be better equipped to navigate future volatility, not just in silver, but across all financial markets. So that brings us to the end of today's discussion. The silver market episode wasn't just about prices going up or down. It was about understanding how modern markets really work. We saw how leverage, futures trading, institutional power, macroeconomic forces, and investor psychology can come together to create extreme volatility, even when physical demand and long-term fundamentals remain strong. If there's one key takeaway, it's this: short-term price movements don't always reflect long-term value. Markets are complex, and to navigate them wisely, we need to look beyond headlines and understand the structure beneath the surface. I hope this breakdown helped you see the bigger picture and gave you clarity rather than confusion. If you found value in this video, make sure to like, share, and subscribe to the channel so you don't miss future deep dive analysis on markets, metals, and global financial trends. Thank you so much for watching and for spending your time here with me. Your support means a lot. Until next time, stay informed, stay curious, and I'll see you in the next video. Goodbye and take care.